people, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or investment in an apartment house, but it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment, and you can't pick them from day to day. If you can do that, you can, well, I haven't met anybody yet that knows how to do it. Darwin said if you found evidence that was contrary to what you already believed, write it down in 30 minutes or your mind will just block it out. I mean, people have a great resistance to new evidence. We don't get rich on our dividends that we receive, although we have to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company, and Berkshire has retained earnings ever since we started. That's the only reason Berkshire's worth a lot more, is we retain earnings. If you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own. American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like, and you can buy it even cheaper, then it's your good luck, basically. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. If you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page, you should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower in it. But you don't. If you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear. If you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I've saved all this money all my life, and now I can only get 1% out. What do I do? The answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%. No, people are reaching for yield. There's no question about that. And that's stupid. And it has consequences over time. But it's very human. You get more trouble with a good idea than a bad idea, because the good idea works. I mean, it's a good idea to buy a home, for example, and then people go crazy. The good idea works, and it works, and it works. Stocks work out better than bonds most of the time. And after a while, people forget that there were some other limiting conditions. With Edgar Lawrence Smith's book, it was that when bonds yield the same as stocks, which was the case then, that stocks are going to outperform because they have this retained earnings. So stocks started going up in the 20s, and all of a sudden they were selling at 5 or 6 times the prices as when he bought the book. And the original correct perception on his part had experienced changing conditions, but people just looked. They got their confirmation through stock prices, and that's what happens in bull markets. People start out thinking stocks are cheap, and then they start thinking stocks have gone up. And a stock can be a good buy or a bad buy. A bond can be a good buy or a bad buy. It depends on price. If you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case. I mean, it's been the case in America, very usually been the case. And if you buy a 30-year bond today with yield 2%, you're paying 50 times earnings for an investment where the earnings can't go up for 30 years. Now, if somebody said, I want to sell you a stock that's at 50 times earnings and the earnings can't go up for 30 years, you'd say that doesn't sound very good. Stocks are way better than 30-year bonds. I mean, it's clear, and that's one of the alternatives people have. People really have three basic alternatives: short-term cash, which is an option of doing something later on; long-term bonds, or long-term stocks. And stocks are cheaper than bonds. There's always trouble coming. There was trouble coming in 1942 when I bought that first stock. All kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks. We're not buying the stock market. We're saying I am buying, let's say American Express. We own American Express. It's selling for roughly $100 billion. Now the real question, it isn't what the stock is going to do tomorrow or next week or next month. There's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. I don't have the faintest idea what our businesses will be doing 6 months from now or 12 months from now. I do think that not only our businesses, but American business generally will be doing fabulously better 30 years from now or 20 years from now. And the long term is very, in my view, is very easy to predict in a general way, but an important way. I don't think there's any way to predict what the stock market will do 10 minutes from now, 10 days from now, or 10 months from now. So I work on what I think I'm able to do, and as desirable as it might be to know what was going to happen 10 minutes from now, that's just not something I'll ever be able to master. So fortunately, I can come to a pretty firm conclusion that 20 or 30 years from now, America business and probably over the world will be far better than it is now. The real question is where are those businesses going to be in 5 or 10 years? They'll have ups and downs. Our candy business is a wonderful business, but it loses money 7 months out of the year. But the nice thing is Christmas comes every year. But I also don't think that I can make money by predicting what's going to go on next week or next month. I do think I can make money by predicting what's going to happen in 10 years. We've got a big investment in the airline business, and I just heard, even more flights are canceled and all that. But flights are canceled for weather. It so happens in this case they're going to be canceled for longer. If you own airlines for 10 or 20 years, you're going to have some ups and downs in current business, and some of them will be weather-related, and they can be all kinds of things. The real question is how many passengers are they going to be carrying 10 years from now and 15 years from now, and what will margins be, and what will the competitive position be? If to go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. I mean, there's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of. The banks are going to make more money if there are higher rates with a steeper curve. American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well. We've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones, and they don't talk about negative interest rate. It never crossed their mind. How was supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. We've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation. If you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has. The American public has been going wild in their enthusiasm for conglomerates in the last few years, if you think about it. I mean, it's been an incredibly popular area, but they call them index funds. I've recommended, index funds to lots of people, and when they do it, they're buying into 500 businesses. And they're going to have 500 businesses a year from now and 5 years from now, and they think that group of businesses that will do very well. And I think our group of businesses will do okay. Banking is a good business if you don't do dumb things on the asset side. I mean, basically. And the commercial banks earn between 12% and 16% or so on net tangible assets. That's a good business. It's a fantastic business against the long-term bond, at 2%. If you have a choice between a 2% instrument and a 12% instrument, which one's going to win over time? So if you ask me whether I think banks are going to go down where they only earn 3 or 4% on tangible assets, I don't think that'll happen. The question is really whether they do something massively dumb, which periodically a number of banks have done. And I feel very good about the banks we own. They're very attractive compared to most other securities I see. You're going to do dumb things in business. And we do them every day, but they absolutely have to attack a problem as soon as it occurs, and you know about it. Something will change in a major way. I just don't know what. When people get terrified, and they will occasionally, everything freezes. And you're going to have to stand on your own feet at a time like that. It won't happen very often, but it'll happen occasionally. We own 5.5% or a little over % of Apple. It's probably the best business I know in the world, and we own 5.5% of it. And that is a bigger commitment that we have in anything except insurance and the railroad. So it's our third largest business. All kinds of things are going to happen to Apple for the next 10 years. The real question is, what is the degree of pervasiveness and strength of that product 5 or 10 years from now? And I don't think of Apple as a stock. I think it's our third largest business. Incredibly useful product to people that grows more useful as the number of people. It's really interesting, we call them smartphones. If you go back and look at the old telephone, that was an incredible useful product. It changed my mother's life and my dad's life. It changed lives in every way, and they took a long time to become pervasive, and it was very expensive initially, but it changed the world. And the smartphone is part of hundreds and hundreds of millions of people's lives in all aspects of their lives. It's used as all kinds of utility. It's a consumer product. Charlie has the best 30-second mind in the world, so I can go to him with a new question, a new problem of any kind, and it goes through about 8 filters in his mind in 10 seconds, and he gets to the essence of any problem. There is nobody better to talk to than Charlie at age 96. We talk particularly about things we don't know the answer to. We do not understand at all what the outcome will be in a world where $13 trillion is being borrowed at less than zero. And at the same time, in this country, we're having, under very good business and market conditions, we're having a 4.5% federal deficit, and nobody is concerned in the least. And we're talking about massive new programs and so on. Everybody talks about how they'll pay for them, but they really, the deficit's going to widen. So we don't know what world comes out of something where you start with extremely low interest rates. It makes no sense to lend money at 1.4% to the U.S. government when it's government policy to have 2% a year inflation. The government is telling you we're going to give you 1.4% and tax you on it. And on the other hand, we're going to presumably devalue that money at 2% a year. So these are very unusual conditions. And classical economics, it doesn't appear. The game is always changing, but it always looks logical in retrospect, and it always looks puzzling prospectively. But there's always things to do that make sense, too. We're allowing people to borrow money on much weaker terms than we were 5 or 10 years ago. You couldn't borrow money at all there for a period of 10 years ago. You literally, Berkshire couldn't borrow money. Everything stopped. And it's hard to believe that 10 years or 20 years from now, we will have a substantial continuation of negative interest rates. Cryptocurrencies basically have no value, and they don't produce anything. So you can look at your little ledger item for the next 20 years, and it says you've got X of this cryptocurrency or that. It doesn't reproduce, it doesn't deliver, it can't mail you a check, it can't do anything. And what you hope is that somebody else comes along and pays you more money for it later on. But then that person's got the problem. But in terms of value, zero. I may start a Warren currency. Maybe I can create one, and I'll say there's only going to be 21 million of them, and you can have a little ledger sheet from me and everything that says you have it, and you can have it after I die, but you can't do anything with it except sell it to somebody else. And the interesting thing, of course, is that Bitcoin's been out there a long time, and people talked about how it would be used in various kinds of exchange, but none of our companies are doing business in Bitcoin or anything. Bitcoin has been used, I think, to move around a fair amount of money illegally. The logical move from the introduction of Bitcoin is to go short suitcases, because the money that was taken in suitcases from one country to another, suitcases will probably fall off in demand. So you can look at that as the economic contribution of Bitcoin to the society.